495 handle. Looking to reclaim that number. We've got as high as about 496, something like that on Monday. In the FX market, close to 109 on the euro against the dollar, 108.97, positive 0.2%, and crude approaching 72, 71.90, up by about 3%. Tons of data between now and Friday. Payrolls on Friday, of course. Fed minutes a little bit later on this afternoon. A read on the jobs market, jolts, job openings, of course, jobless claims, the ADP report. Throw in some services ISM information as well. Fed minutes a little bit later on this afternoon. A lot to get our teeth into as we really ramp up this week. One sector to watch at the open, big tech. Stocks exposed to recent US-China trade tensions under pressure following a report from the Wall Street Journal saying the Biden administration is preparing to restrict Chinese companies' access to US cloud computing services. Abby has more on this. Hey, Abby.
Hey, John. Well, this seems to be one more time where we're hearing about potential tensions or actual tensions between the U.S. and China and restrictions around tech. Of course, we have the ongoing tension around chips. Right now, though, it seems to be more of a the talk situation as opposed to walk the walk. If you recall, many years ago, there were the tariffs, and that actually really created a situation where you had stocks go down severely. Right now, though, we do have some weakness for these big tech names. You were talking about the incredible rally that we have for the S&P 500, up 16% halfway through. The NASDAQ 100 up about 40% halfway through its best first half ever, having to do with these stocks, NVIDIA in particular, being up 190% on the year, but Microsoft up 40%, not so shabby, and Amazon up 55% year to date, not so shabby. So the question is, will these tensions increase enough to really take a bite out of those stocks? If so, it could mean trouble for the indexes. Of course, as you know, Treasury Secretary Janet Yellen going over to China later this week. I believe tomorrow, in fact, she arrives, and to try to maybe calm some of these nerves. But right now, and actually not so much weakness at all, John.
Abby, thank you. Let me get you another tech name. Netflix doing quite nicely around the opening bout. Goldman upgrading the stock to neutral and writing this. Management has executed its password sharing initiative in excess of our prior assumptions, regained content creation momentum, and competition has become more muted. That stock is up by about 1.8% this morning. Year to date, it's higher by more than 50%. Some big gains out there for big tech, including Netflix year to date and this morning up another 1.5%. I want to turn to biotech as well. Shares of Moderna in focus following a report that it's set to announce its first investment within China amounting to roughly $1 billion. Joining us now on the story, Bloomberg's Kelly Lyons. Hi, Kelly.
Hey, John. Well, those gains are building for Moderna as the session grows a few minutes older, now up more than 4% here in the first few minutes of trading. As you said, this would be the first investment the company is making in China, signing a memorandum of understanding as well as a land collaboration agreement to research, develop, and produce mRNA vaccines in that market. Now, Moderna isn't directly commenting on the size of this investment, but a local media outlet, UK, earlier reported that it could be around $1 billion. Of course, the timing of this interesting, as Abigail was just talking about, Treasury Secretary Janet Yellen getting ready to go to China in the coming days, escalating tensions between these two economies. But we have to keep in mind, this is a company, Moderna, that is looking to its post-COVID future, trying to expand that pipeline, and it looks like new markets. On the subject of the pipeline as well, I would note separately today we did get news that it is filing for approval of its RSV vaccine that uses this mRNA technology in both Europe and Australia, and has started the process to get FDA approval as well. So trying to look toward the future here, John. Remember, Moderna is down 73% from its peak in August of 2021, but it is gaining this morning, up about 4.1% as we speak, John.
Kelly, thank you. About 126 in early trading. Kelly Lyons there on the latest there. I want to turn back to tech. Instagram's highly anticipated Twitter rival Threads expected to launch tomorrow. A listing for it on Apple's App Store reading, quote, "Threads is where communities come together to discuss everything from the topics you care about today to what will be trending tomorrow." Joining us now on that story, Mandeep Singh. Mandeep, how big is this going to be?
I think it's coming at a good time in the sense that, Meta as a stock has done well this year, and they've proven that they could catch up from behind, as has been the case with Reels. So for the longest time, everyone didn't give them a chance, with the videos and Reels product, and they've proven that they can take it to $5 billion run rate. So my sense is, given what's going on with Twitter and, Twitter restricting the number of tweets people can have as unpaid users, it's a good time because you see so many other apps, Mastodon, Blue Sky, so it's up for grabs in terms of engagement, and I think Meta is best positioned to launch a product like this.
Mandeep, just to be clear, it won't launch in Europe, right? Is that the latest?
That is correct, yes. The initial version would be a more US-centric and other parts except Europe, given this will involve data sharing across their family of apps. So remember, they are going to try to leverage what they know about the user graph from the Core Blue app, Instagram, as well as their WhatsApp messaging app. And I think the data sharing is a problem when it comes to the EU side.
Mandeep, do you have a decent idea of how this works in practice? If I have an Instagram handle, do I automatically have a Threads handle? Do I take my audience with me?
They will definitely make it easy for you to port over stuff from Instagram, Blue app, and WhatsApp. And clearly that is the plug that they are offering to bring in more creators to the platform.
Any idea how Twitter responds to this and how they, to be more specific, the creditors to Twitter respond to this?
I think Twitter right now is too focused on, companies using their data for large language models, which is why they restricted the access to tweets to 600 per day. The risk they run is if the creators move over to another competing platform, whether it's Blue Sky or Meta Threads, then they're never going to come back. And that's where they have to be very careful with the subscriptions as well as restricting the access.
Mandeep, thank you. More from Mandeep tomorrow on this story. Meta right now up by about 0.25%. Year to date, of course, explosive gains of more than 100% year to date. Let's talk about Rivian making its first commercial shipments outside of the United States, sending electric vans it makes for Amazon to Europe. A Rivian executive writing in a statement, "We've had incredible feedback from drivers in the US and we're excited to start international expansion in Germany. We're very excited about our future in the region." Katie, they sound very excited.
They do sound very excited, and you can expect to see more than 300 of the electric vans that Rivian makes for Amazon on the German roads in the weeks ahead. Like you say, this is Rivian's first international commercial shipments outside of the U.S. Now, for context, Amazon, of course, is Rivian's largest shareholder, its biggest customer, and it's ordered 100,000 of these vans to be delivered by the end of the decade. We now know that that process has started, and that's one of the reasons why we saw D.A. Davidson upgrade Rivian to neutral, citing that the European deliveries started far earlier than they had anticipated. And you also had some more love from the sell side for this stock. Needham lifted its price target to $28. That, of course, follows Rivian's better than expected 2Q production and delivery numbers. So you add it all together, the stock currently up about 2%. It had been as high as 6% in the pre-market. But if this gain holds, John, it will be the 6th consecutive day of gains, and that follows a 17% pop on Monday alone.
Unreal. Katie, thank you. That's the latest on Rivian. Here's the latest price action right now, about 7 or 8 minutes into the session. We're negative 0.3% on the S&P. On the Nasdaq, we're down about 0.2. The second half one underway now. Big tech coming off the back of one of its best first half performances on record. Chris Harvey of Wells Fargo weighing in, writing, quote, "A series of solid economic releases sustained the year-to-date stock rally and advanced the view that a recession may be avoidable." I'm pleased to say that Chris Harvey joins us now for more. Chris, always wonderful to catch up, mate. Last time we talked, we were talking about a 10% correction back in April, I believe. What's happening with that now?
Yeah, I think that's off the table. We are still looking for some sort of pullback. We think markets are overbought at this point in time, but 10%, I think that's too aggressive at this juncture. We missed the mark on that one. We were aggressive, but we tried to get a little bit too cute, and what we think is you're going to see a broadening out of the market from here. We do think there'll be some sort of pullback, but the pullbacks as we go forward, I think will be shorter and shallower in the 2, 3, 4, 5% range. And that's what we've been seeing. Very short, very shallow pullbacks. Until we see the Fed getting more aggressive, I think that's going to be the case as we go forward.
Chris, I appreciate your honesty. So many people have struggled with this market, so there's a lot of people in the same boat. Can you just talk to me about what you've seen that has changed, that's led you to believe that we get a further broadening out of the equity rally?
Yeah, John, it's really a timing issue. A lot of things that we thought were going to play out have played out, but it's really the market's been somewhat Teflon. And the market's been Teflon for some of the things that we've been talking about, we appreciated early on, but just didn't appreciate the gravity. Right? The consumer has been stronger than expected. The economy, what we have been saying, and the phrase we've been using is an economic malaise. We did think the banking situation would put a little bit more ripple into the market, but that didn't happen. Furthermore, we thought the Fed would be a little bit more aggressive. And in addition to that, some of the things that we thought from a macro point of view, whether it was a debt ceiling or with student loan, have played out, but they just really haven't affected the stock market. And one of the things that we knew about, but really didn't appreciate the magnitude of it, it was just positioning. Positioning has been very weak from the buy side. People have been underweight, or institutions have been underweight a lot of these mega cap and a lot of these AI names. And there's been a bit more to chase. But overall, what's happening is the timing of this slowdown has been pushed back. Again, the consumer and the corporations, which we thought was true, just people are coming more to the rationalization that the consumer's in an okay place, the corporation's in an okay place, and we're just going to muddle along. And then the last thing is, it's just, we haven't had, again, what we're talking about, what we're seeing, what we're looking at is an economic malaise. And what's been happening underneath the surface is certain parts of the market have been weakening, certain parts of the market have been just going sideways, and other parts of the market have been recovering. And so this is a very unusual economy and a much stronger economy than expected.
Chris, I was going through your research and you identified something many other people have identified as well. The surprise index story, just where the data's been coming in relative to where it was expected to come in. Those indices, that index now is the highest since 2021. And Chris, it's really led me to ask this question of you. Are things just better than expected, or are things kind of improving, getting better?
John, I don't think things are improving. I think what happened is expectations and sentiment became very negative. One of the questions we get, one of the questions we've been dealing with is EPS numbers or revisions were very negative in the first quarter or coming into the first quarter. They were revised down and now they're being revised up. And I think people just got too aggressive to the negative side. I don't think we're looking at a recovery at this point in time. I do think we're looking at this economic malaise, but a lot of people are saying, hey, look at home builders. Hey, look at credit spreads. Hey, look, the Fed can't break things. And that's true, but it's hard for me to see this really strong recovery when we haven't had that big a pullback. And so I just don't know how much is left in the tank. I don't think we're recovering per se. What I do think is there's certain parts of the market that are recovering. And again, certain parts that are just going sideways and certain parts that are beginning to roll over.
Well, you say,
and so you can really see what you want to see.
If I can jump in, Chris, it's kind of amazing to see him at 387. I've been away for a couple of weeks, so just to tune back into the market and see where things are. Credit spreads are really tight. Home builders are up by more than 40% so far year to date. When you say things like it can broaden out, Chris, what do you like right now? What are you looking for? And are you seeing evidence that that is happening?
Yeah, we are seeing small caps and mid caps do much better. We are seeing a broadening out of the market. It's slow and steady. We started to see this in the beginning of June, and this has been kind of something that up over the last. And what I think is happening is typically with the mid and the smaller cap stocks is and if we're going to push back our economic fears, then those stocks should begin to work a bit better, and that's what's happening. As far as what we like, we still like growth. We still like GARP. We like mid-cap GARP. We like media and entertainment. So that hasn't changed so much. We do think the market's going to broaden out here, and it's really related to the perception. I mean, not so much that the economy has changed, but just the perception on the economy and the pushback of some of these economic fears.
Chris, just one final one then, with regards to that specifically. Where does that leave energy?
Yeah, energy's it's a wait-and-see story. I think it's a walk, not run type situation. Because again, we're still worried that the Fed needs to do more and that things aren't going to accelerate as we look forward, and energy being more economically sensitive. We could see a balance, but I don't think we're ready to go overweight the name. We're still neutral on the space, and we're just looking for a little bit more opportunity, a little bit more margin of safety, and for the economy and things to move a little bit further along.
What a year we've had so far. Another 6 months to go. Chris Harvey of Wells Fargo. Chris, appreciate it as always, mate, and appreciate the honesty as well. It's been such a difficult year for so many people who have missed this rally. Big time on the NASDAQ, up by close to 40%, and the S&P double-digit gains. Remember when we started the year and we weren't going to see any of that, and then we did very quickly. Your equity market at the moment, about 14 minutes into the session, down 0.2%. The NASDAQ down by about 0.1%. No real drama here as the week begins to ramp up, looking ahead to payrolls Friday. Before we get there, we need to deal with OPEC. Up next, production cuts cuts in focus as the OPEC Plus seminar begins.
People sometimes ask, why then you had to do, as Saudi Arabia, the voluntary cut? And my answer is very simple. We had to do it because there was another ask for the market, a more immediate ask or a more immediate expectations of the market that the OPEC Plus would need to do so.
Bloomberg's Manus Cranny on the ground in Vienna, up next.
Billions of people depend on our commodity, oil, for daily life. This is an inescapable reality that warrants respect. That is why OPEC pursues market stability. Of course, as an industry, we want to ensure that we have an emissions-free future. Harnessing technologies that can do this will be one of the predominant themes of the seminar. However, oil is too central and fundamental for life just to stop.
The OPEC Plus seminar kicking off on the heels of production cuts by Saudi Arabia and Russia. The UAE announcing that it won't be making further supply cuts, saying the nation is already doing enough to contribute. Bloomberg's Manus Cranny joins us now from Vienna with more. Hey, Manus.
Jonathan, very good afternoon. It wasn't supposed to be this way, was it?
Talk to me about it.
Well, I'll tell you what happened. It was supposed to be a beautifully spectacular backdrop for you outside the Hofburg Palace. I decamped to the Hyatt, the Park Hyatt, which is where the Saudis are staying. Of course, the Saudis are center stage. What we have here, Jonathan, I say, is a pretty classic moment of where the market was doubtful. You know the phrase, do whatever it takes. You remember it, I remember it. Mario Draghi christened it. Here we are again. Prince Abdulaziz bin Salman keeps using it. And I thought to myself, I was sitting here waiting to come on. I thought, what does that really mean? What it means is an extension of a unilateral cut of 1 million barrels a day, but to do whatever it takes actually means he shifted the political narrative, because now the Russians have stepped up to the plate. They're doing 500,000 barrels of a cut in exports, and this is the important point. They're prepared to cut exports, which is what we can manage and understand. Don't worry too much about whether they're going to cut production, because who knows? That's like a big dark vortex. It's a bit like my life at the moment. But that's the point. That is the fundamental point. Cushing, which is, of course, in the United States of America, we have a problem. We have an oversupply problem from Iran, Venezuela, from the United States of America, and from Russia. And so we're desperately trying to grapple back some control on the supply narrative.
Manus, what does that mean for pricing? And are they comfortable with where we are right now at 76 on Brent? Where are they going to be comfortable?
Well, put it this way. 4 weeks ago, I was here in Vienna outside the OPEC headquarters, and they did a unilateral cut, which was quite unexpected. And the market went, yeah, and what else? So 74, 76, 74, 76, you can trade that range all day. You could even write some volatility into this. But the point about it is, I would say that they've created a floor. So in other words, we've taken 3% of the global production off the market. And they kept trying to push the selling prices to China and Asia higher. That invoked destocking in China and in Asia. And that's where the battle is at the moment. 74, 76 is not acceptable to either the economic dream of Saudi Arabia or to the war plans of Putin in terms of the dollars that he needs to fund the war. And Mohammed bin Salman needs to deliver an economic dream. I say it again and again and again. To deliver on the Alula dream, the Red Sea, etc., takes $100 on break even. Fiscally, the IMF says $80. This is a floor protection mechanism rather than creating the narrative for $100 oil. Jonathan.
Manus, thank you. I've loved the coverage. We can have a therapy session on the phone a little bit later and talk about life's problems. Manus, thank you. About 22 minutes into the session, equities negative 0.2% on the S&P and the Nasdaq down by 0.1. Let's lift the lid on this index and get you some sector price action. Back with us, here's Abby.
Well, it's hard to follow that one, John, but we will try. And relative to sector action, not surprisingly, with the S&P 500 down slightly, we have more sectors off than not. The worst is materials down 1.5%, then the financials, industrials. Speaking of energy, there it is, down 0.4%. To the upside, though, communication services up about 0.9%. Let's take another look at those banks, because we've had some real strength for the banks recently over the last couple of days, but not so much today. We have weakness for the S&P 500 financials, the KBW Bank Index, along with the regionals. It's not entirely clear what's behind this, John, but there you have it. Some weakness again for the banks, even with yields. Well, at this point, we now have that 2-year yield coming in, so maybe that's a piece of it.
Bank earnings a week away. Abby, thanks for that. Up next on the programme, your trading diary. Snapped a three-day winning streak at the moment on the S&P 500. Let's see if we can break that in the next few hours. We're down just a little bit on the S&P. We're down about 0.2%. On the Nasdaq, shifting into positive territory, outperforming the Russell, has done all year. On the Nasdaq right now, positive 0.1%. The Russell, the small caps, deeply negative, down by a little more than 1 full percentage point. That's the price action as we kick off the back end of the week. Let's get to the trading diary. Fed minutes coming up a little bit later, 2 p.m. Eastern time. New York Fed President John Williams speaking at 4 p.m. this afternoon. A touch of Fed speak for you. Then Secretary Yellen arriving in Beijing tomorrow. We'll get another round of jobless claims too, and JOLTS numbers, the job openings report ahead of the payrolls report, the main event on Friday. For those of you interested, the survey right now here at Bloomberg, the numbers, the estimates still pouring in, but the median estimate so far in our survey, 225,000, just down from 339. Unemployment expected to come in. Mike McKee talked about that a little bit earlier. The estimate 3.6%, the previous read 3.7. All of that still to come from New York. That does it for me. Thank you for choosing Bloomberg TV. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, July 5th. Here are the top market stories that we're following for you at this hour. The China factor. Treasury Secretary Janet Yellen leaves for China today after a few days of tit-for-tat trade restrictions. And you got the X factor. Stocks trade a bit heavy, two-year yield pushing a bit higher. We're going to break down the catalyst from China to jobs. And the weather factor, yep, this one is for a guy. Here it is seriously hot. All across the world, it could actually get worse. We're going to take a look at the commodity impact. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I like obsessively now look at the air quality index every day. So I'm turning into you. It's a good feeling.
It is a good feeling. One should always aspire to something just like that. Yeah, welcome back. You haven't missed very much. I'm kind of waiting for this week to get started, Alex. I'm not sure it has yet. I'm looking at the data as well. Factory goods doing nothing. Durable goods look like they're in line. Factory orders look a little light. Nothing has really happened so far this week. The Chinese data is a little bit weak. I'm kind of hoping that maybe the minutes give us some fireworks because, well, you guys have had fireworks, we haven't. And then we get on to jobs and we get on to payrolls. Nothing has happened so far this week. When does this week get going?
Well, I mean,
now that you're back, maybe it does.
Maybe. He was so excited to see me because he thought maybe I'd bring some news with me. I mean, even the bond market, I mean, a little bit softer now. You got a big coming in the front end, softer yields now down by about 3 basis points on the data. So, okay, that is a little bit light. We'll see how that trades throughout the day. But it does feel like we're looking for a catalyst, and it feels like we're pushing a little bit to Jobs Friday at this point.
Oh, yeah. I think the JOLTS number tomorrow could be interesting. But yeah, you're right. The payroll number Friday is going to be the big one. And this Yellen trip, maybe that's going to provide some catalyst. I doubt it. I think expectations are super low. And we did have the data from earlier out of China. The Caixin came in a little light. But we're all getting used to the idea that China is perennially disappointing at this point. We thought it was going to be a big year for China. It's turned out to be quite the opposite. But the first half of the year has disappointed on so many fronts. And maybe it's excited on others. All of the ones we didn't think would be sort of going up, have gone up. All the points we thought were going to be going down, didn't. Anyway, let's talk about our question of the day, if that made sense. When does China go? It's been one of those weeks. Honestly, it's a struggle. When does China go from being a headwind to a tailwind? Enda Curran joins us now. Anne-Marie Horden joins us now. They're both in the same studio in Washington, D.C., which is exciting, but they are in separate boxes, but they are sitting next to each other. Anne-Marie, let me start with you. We're waiting to see what happens in China. We're trying to figure out what is going to happen next. We're looking for stimulus, and we're looking for some sort of clarity on what is going to develop in terms of relations between China and the United States. Expectations for the Yellen trip are low. There's no real expectation that she's going to change things. Is there an expectation at some point that they do, or is this the new normal?
This does feel very much like the new normal because remember, she's going also at a very difficult time. She's kind of in the eye of the storm right now. We're seeing tit-for-tat messages between Washington and Beijing. So Washington, what Jenny Leonard and I are reporting, the first ones to report about this trip in early July, was also that the administration is really ramping up work when it comes to the executive order on outbound investment. We could see that as soon as the end of this month. At the same time, the Wall Street Journal is reporting that maybe potentially the United States is going to start to ratchet out some of these concerns regarding China when it comes to cloud computing services. And then China is responding in a way. They're saying due to national security concerns, they're also going to limit the ability to get a hold of some critical materials that are used across technology and defense space. So this is the atmosphere to which the Treasury Secretary is going into these meetings. So just the fact that she's going is really the win of the meeting. When she was asked about potentially going on this trip to MSNBC, she said that this is really just about getting to know each other. She's meeting a brand new counterpart as well. So that's really the top line of the meeting, that they are, in fact, meeting.
Right. So like maybe that expectation is low. I mean, the rare earth saying, I've been covering commodities for 16 and a half years, and I have been like, that's been front and center for those 16 and a half years. And when do you think that China goes to a tailwind from a headwind?
Well, I think it's kind of heading in that direction at the moment. As Guy set it up nicely, at the start of the year, there was so much hope for China's economy in terms of the spillover effect from the post-COVID reopening. It's not playing out like that. We had numbers overnight showing now the services side of things is slowing down. That had been the bright spot. So car sales are coming off the ball. Domestic tourism over the Dragon Boat holiday was below pre-pandemic levels. And of course, the real estate sector remains in a slump there. We had news overnight of more distress around big property developers trying to sell off developments or raise money in the credit market. So the story is disappointing. However, it should be said, China remains on track to hit its 5.5% growth target this year. And that's what the government set at the start of the year.
So if that's the case, Enda, are we going to see the stimulus that a lot of people are arguing is required? Are we going to get that as the tailwind? And if it doesn't show up, what does the back half of the year look like?
Yeah, well, on face value, clearly the economy is crying out for support, given all the data, all the metrics coming out of there. They have been tweaking short-term interest rates, Guy, but nobody really thinks that's going to turn things around. In terms of revving up animal spirits in China, it will probably require getting money into households, getting cash to people in a way China's authorities haven't done before. But, you know, broadly speaking, the China watching community isn't convinced that they're there yet, because as I just said to you, there is a view that, wait a minute, China's on track to still hit that 5.5% growth target, or 5-odd% growth target. That's the political imperative. The government's willing to hold its nerve, so to speak, isn't going to panic. Remember, they've had this broad approach to keeping a lid on debt for a while now. They've been happy to lecture the West for going down the road of QE. So there's a view that maybe they hang tight and don't panic and just see how things pan out, and they're on track for that growth target. But, you know, as you say, at the same time, the consumers seem weak, and some kind of support will be needed there. And it's hard to think that it won't put some support in at some point this year.
So, Guy, this is where I think the Janet Yellen trip is interesting, because if we look for a catalyst, right, like we hear the tit for tat, like trade restrictions that are coming down, like if things actually surprise to the upside, does that provide any kind of catalyst, or is this just going to be noise to the market?
I think expectations are really low in terms of how relations are developing. So I think anything that would suggest that relations are improving, I think would be taken as a significant positive by the market. But I think I think that the whole conversation between China and the United States is fascinating at the moment. In some ways, while we expect China to stimulate, it's the United States that is stimulating. Yeah. Bidenomics in some way is just a reaction, Amory, to what we've seen China already do. And while the Chinese are upset about the kind of the new industrial policy that the administration is pursuing, it is a reflection of what they have done in the past. Maybe we're looking the wrong way for the tailwind. The tailwind is already coming out of the United States.
Yeah, Xi Jinping also, I believe it was overnight, talking about the fact that he does not want to see a fragmented global economy, really just throwing stones at the U.S. in terms of what they're doing and trying to nearshore or onshore and shoring up these supply chains in other countries outside of China. But Guy, it's a great point on Bidenomics, as this administration tries to really start to own that term, which was first used in a Wall Street Journal editorial criticizing them. Part of it is not just a full domestic play, but it's also a foreign policy play on China. What they're trying to do is bring manufacturing back to America, especially for some of these critical areas. I believe one of these critical raw materials that China is having some restrictions on, whether or not it was galenium or germanium, the United States only has one processing plant for one of those materials. China has an absolutely oversized domination of these markets. So that is part of the Biden plan to fight foreign policy by doing so domestically.
Well, I think that's interesting, too, because it's not like the rest of the world doesn't have the deposits. We just haven't gotten them up and running yet.
Process them.
Right. Well, also it's finding them and then processing them. So it's less like, oh, we're totally dependent. It's just the investment really hasn't been there. And how worried do you think that China actually is about this reshoring, onshoring, bringing manufacturing back? Because in theory, you could look at it's been happening for a few years now.
Yeah, it was happening before the pandemic and the geopolitical tensions. As you mentioned, Alex, wages were getting higher, environmental standards were getting higher in China, so companies were having to look elsewhere, and we all know the Vietnam story, for example. Nonetheless, there are signs that the authorities do seem to be a little bit worried about it. They've been sending those signals again lately that they are open for business, they want foreign investment. The Premier, Li Qiang, on that European tour last week, made a direct plea to companies. He said, look, come and deal with us directly. Don't worry about what's going on over your heads in terms of the political story. So there are some nerves there. But China, remember, has a trump card up its sleeve when it comes to this, and that is they have scale. They have scale when it comes to manufacturing and industrial capacity that nobody else can really rival. Of course, India can, but India's infrastructure has a way to go yet. And for now, at least, I think the FDI data continues to show that the broad manufacturing base in China is holding up.
All right, guys, really appreciate it. Thanks for setting us up. Anna Kern and Anne-Marie Horder both joining us from D.C. So coming up, we're going to put our question of the day of when does China go from a headwind to a tailwind to Karen Murphy, CIO at Kestra Investment Management. This is Bloomberg.
The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters?
We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policies.
The Fed is going to hang tough.
The June Jobs Report, Friday on Bloomberg Television and Radio.
They're talking tough now, but I think maybe they could get it watered down a bit when they have the meetings. I still think the biggest problem of all is chips. Computer chips is a big issue. The U.S. has not relented. We still haven't relented on the Donald Trump tariffs. So I think the chips issue may be the biggest of all.
That was Greg Valliere, Chief U.S. Policy Strategist at AGF Investment, previewing Janet Yellen's trip to China. So I want to get back to the question of the day. When does China go from a headwind to a tailwind? Joining us now is Kara Murphy, CIO at Kestra Investment Management. Kara, what do you think?
Such an interesting question, because it brings me back to earlier this year when the assumption was that China was about to turn. And in fact, I remember we got a lot of pushback on our cautious view of commodities on the idea that China was coming back, it was going to fuel demand growth. Now, fast forward 6 months, and it's the U.S. economy that's been much stronger than expected, and China has really lagged. So going forward then, I think the important thing for folks to remember is that internally within China, there's been a bit of a shift politically in that the party has started to shift from, a very strong focus on the economy and driving growth to more shoring itself up from a political sense. So what that means is that even as China does, turn from that tailwind to a headwind, headwind to tailwind, that tailwind might not be as strong as what we're hoping, simply because it isn't as much of a priority for the Chinese government as it used to be.
It's going to be interesting to see whether that coincides, Kara, good morning, with the U.S. beginning to roll over a little bit. If that China stimulus is not that dramatic, where does that leave the global economy? Where do investors go at that point?
Well, again, I think the biggest headwind facing the global economy is not necessarily, China being softer, but this incredible monetary tightening that we've had for, many months now. And we keep talking about this sort of tsunami of tightening that's begun to filter in certain areas of the global economy, certainly manufacturing, but still seeing a lot of strength, not just in the U.S., but in some markets outside. And we still have yet to see what the full impact of some of that tightening is going to be.
So I guess flip it. Does the West look like a headwind or a tailwind? Because you can make an argument that higher rates, right, that's the headwind, et cetera, especially as data comes in relatively okay. But then the tailwind could be all that fiscal spending. Like we just saw the Biden administration saying that they're going to invest in hydrogen plants, for example. How do you look at that?
So I think fiscal spending can be very important for individual sectors, and you were talking about rare earth minerals earlier and this whole idea of onshoring. I think those are very important for certain areas of the economy. But when you size that fiscal spend relative to the size of the U.S. economy, it's still relatively small. And certainly when we compare it to the fiscal spend that we had in 2020 to combat the pandemic. So yes, it'll help on the margin, but size-wise relative to the monetary tightening, it's still relatively small.
Kara, do you think the second half is going to be easier or harder to get right than the first half? Because the first half has confounded absolutely everybody.
Right. And you know the expression in the market, the easy money's already been made. And so, the first half certainly didn't feel like easy money because expectations were so cautious in the first half. But it's really a matter of matching what the fundamentals, like what the corporate earnings are that really drive long-term growth versus what expectations are. And that's where we start to get a little bit cautious. We're looking at valuations that are above 20 times right now. Earnings have held in better than expected, but they're still not totally gangbusters, so it seems a little hard to justify that high valuation. So heading into the second half, we would still expect it to be a bit more choppy.
So, Guy, that brings up an excellent point in terms of earnings expectations, right? Like we know the story with tech. We saw a brief try at a rotation into cyclicals and, say, small caps. And small caps are quite interesting. Like they're underperforming today by far. But Bloomberg Intelligence says, look, the next few quarters, though, you're going to see profits expanding. Maybe not at the rate of some of the bigger firms, but they will expand. So kind of where does that then leave you?
There's a bunch of weird things going on, isn't there?
Yeah.
Sorry. But Cara, you've had high yield outperforming IG, which in theory you would have thought would mean that you would get small caps outperforming as well. That hasn't happened in the first half. That's been a little bit of a conundrum. And Cara, you've had this incredibly tight market. It's really interesting. In the United States, growth has done really well. Value has been horrible. Here in Europe, value's been the outperformer. There's been no consistency anywhere. Are there clearer themes in the second half, Cara?
Well, we certainly had a very clear theme in the first half. And, as you're talking about corporate profits, it's interesting because we have had this incredibly narrow market, right? S&P 100 has well outperformed S&P 5. NASDAQ 100 has outperformed the broader NASDAQ. But when we also look at corporate profit margins, they've improved more in those larger companies than the small companies. Yes, we're starting to see better improvement in the small cap companies, but there has been some justification for this very concentrated market. Now, for it to continue to be healthy, we have to see it broaden out, right? We can't forever be reliant on just a handful of companies. So I think in order to sustain this rally, you need to start to have small caps participate.
Will they? Do you? Is that an area where you want to participate in?
We're expecting a broadening out of the market. So overall, you're going to see sort of those leaders start to take a bit of a backseat to some of those mid and smaller cap names. And so I think that, though, that transition will lead to a bit of choppiness in the second half.
Cara, a lot of people have got a lot of money in money market accounts right now. You're getting paid to put that money in there. You're getting paid to wait. That's been one of the stories as well of the first half. In the second half, do I need to buy duration? Do I need to start thinking about the fact that actually these decent yields are not going to be there for that long? Or do you think Bill Dudley could be right? Do you think we could be going to 4.5 on the 10-year?
So you're right. I mean, money market yields are very attractive. We haven't seen yields like that in a long time. And they're really tempting to investors because you can count on them a lot more than, say, going into a diversified bond portfolio. That said, we don't expect those 5% yields to last forever in cash. And so, yes, given the huge amount of Fed tightening that we've already had, remember, that's already baked into bond prices today, we think moving forward, a more diversified portfolio heading out to about mid-duration, even if we see a couple additional Fed rate hikes, we still think that's the better bet for the medium term.
Cara, great to catch up. Nice to see you. Thank you very much indeed for joining us. Cara Murphy of Kestra Investment Management. Alex, still ahead, we need to be talking about the fact that Instagram's apt to rival Twitter is going to be kind of not available here in Europe. It is going to be called Threads. The graphic kind of tells you that, but we can't get it. You can. What does that tell us about the future of this business? We're going to find out next. The startup is coming up. This is Bloomberg.
jobs day like Bloomberg.
It's 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Caroline Hyde, who's back from vacay. Great to see you. Okay, well, let's start with Meta's Twitter clone Threads. Is this really going to be a big threat here to Twitter?
Well, the scale could be phenomenal because it's going to be intertwined with Instagram automatically. So you leverage the same profile, you're able to therefore follow the same accounts, and ultimately the couple of billion people who use it on a monthly basis automatically could start to get into Threads. So I think many are, you see the headlines out there, a Twitter killer. Yes, this is going to be a concern to Twitter if you start to see that this could be a big draw. And as many have said, look, it could be but like a couple of basis point move for a Meta, but this is integral when you think of billions versus, well, we haven't had numbers of Twitter users for months, if not ages now, but it was what, 300 million compared to the 2 billion that Instagram has?
Caroline, it could be big over there, but it might not be big over here.
Yes.
Why?
The EU. Oh, Guy, just remember, it was what, a few weeks ago? Yeah, well, a few weeks ago, I think it was, that we saw Meta get that enormous fine, €1 billion, 1.2 billion, I think it was, because of the way in which Meta shares data between Europe and the US. Well, because of these new, more focused regulations, stricter regulations coming from the Data Protection Commission over in Ireland, or indeed more broadly, the Digital Markets Act that's coming out, well, all of this, of course, means that Instagram themselves, Meta itself, doesn't really know how it's going to be regulated when it shares the data, your user data of Instagram, across to Threads. So for now, if you're in Germany, or in Spain, or in Italy, you're not going to be able to access Threads when it goes live tomorrow.
So, Guy, does this mean that when I bug you about, hey, we should do some Instagram videos together and post it, or hey, we should do a thread thing and post it, you can literally say, I can't stop bugging me?
Actually, I don't know. The UK is no longer part of the EU.
Oh, wow.
So you never know. Maybe we'll be making exciting videos. This is an exciting video. What we're doing right now is an exciting video. But I take your point that maybe actually this could act as a bit of a restriction. I don't know how the UK is going to respond to this. I don't know how it's going to work over here. It's going to be interesting to see how the launch goes and how much demand there is out of Europe. It will be fascinating. Yeah, I'm looking forward to all of those exciting videos we're going to make.
I've been trying to get him to do this for a while. I mean, I stopped for a bit, but you know. So Caroline, is it going to move to the UK? Like, is the UK also going to ban it? What do you think?
Well, to that point, we know that when Brexit occurred, the actual UK users signed up to US agreements. So it's likely that the UK will be able to have it. They've got their own data protection, but for the time being, it's only in the EU. So, Guy, you have no reason.
This is really good news. Yeah, I'm sure I can come up with some, Caroline. Believe you me. We'll come up with some. If there is demand, Alex and I will make some videos.
Guy. For your thought threads, come with.
Yes, we don't find that boring at all. Okay, so what do we know though about Reels and like how Reels did and how Threads will do?
And actually, Bloomberg Intelligence has nice pieces out. Mandeep Singh, of course, friend of every show on Bloomberg, has been writing how well Reels has actually done. And to that point, the artificial intelligence that's intertwined with that, the ways in which people have wanted to use Reels does bode well. For yes, it has been cannibalistic in some ways in terms of advertising dollars because it's pulled away advertising perhaps from Facebook and the OGs and putting towards Reels instead. But the fact that it has been such a success, and look, hate to say it, but Meta is good at copying other people. And with Reels, of course, it took TikTok, and we know that, of course, Stories has done incredibly well from the likes of Snap, and now, well, look out Twitter, and we'll still have to see whether that cage fight happens or not.
Excellent. Well, this is all good news. Videos will be forthcoming. Caroline Hyde, thank you very much indeed. I think Ed's on holiday, so Caroline will be solo a little bit later on Bloomberg Technology. Up next, we're going to talk about the FOMC minutes. This is Bloomberg.
About an hour into the U.S. trading session, stocks a little mixed. The Nasdaq 100 outperforming. Factory orders did come in a bit light for May, but, you know, steady as she goes. Abigail's tracking the moves. Abby?
Yeah, Nasdaq, that is the strength of the day. But here's the weakness, Alex. We have the S&P 500 down ever so slightly. The Dow down more, down about 0.4%, having to do with some weakness for the banks. But we also have weakness for the chips, down about 1%. Of course, it seems as though tensions between the U.S. and China are escalating once again around technology. Right now, more so around the cloud services, but that reminds us about the chip tensions. And then that Russell 2000 on the bank weakness, down about 1%, perhaps ahead of next week with banks kicking off earnings, the regional banks down in addition. Now, on all of this, we have the VIX up ever so slightly, although when I say slightly, I mean a 14 handle. However, there is reason here to believe that we are going to see a significant spike higher in volatility. So here is a range over the last year, back and forth, and now down into the complacency, that 14 handle. This area going down, it's actually the inverse of what's happening for Apple. It is a bearish pattern in terms of stocks. It's bullish for the VIX. It suggests that we are going to see the VIX go back up toward the top of that range, somewhere above 30. What could be the impetus? Earnings really comes to mind. I think that this earnings season has the potential to be interesting relative to outlooks. On the day, though, this is one bright spot. We do have commodities higher. Crude oil up about 2.5%. Wheat, silver also higher. On the year, though, it's a different story, as you know, though, Guy. If we take a look at the divergence between the S&P 500 and the Bloomberg Commodity Index on the year, take a look at this. The S&P 500 up about 16%. The Bloomberg Commodity Index down about 10%. This could be another concern for investors because typically commodities lead, a little bit more sensitive perhaps to the economy, and in the near term, think actually big times in the past ahead of big correction areas in terms of before the GFC. Of course, we had some commodity weakness, volatility. I don't know. This is going to be an interesting summer, Guy, for sure.
Kind of feels like China, though. That bottom white line feels like China was expected to do much more, and it didn't. The U.S. economy has been the one that's outperformed. The U.S. economy has been the one that has surprised everybody. Abigail, thank you very much indeed. To that point, later today we're going to get minutes from the Fed's June meeting. Remember, we got that pause. I think it was a lot of confusion around the logic behind the pause. Why not hike? It was a unanimous decision. Powell has been really hawkish since then. Look at what he said in Sintra. So what are we going to get out of these minutes? Betsy Stevenson, University of Michigan professor of economics and public policy, joins us now. She was chief economist at the U.S. Labor Department and was a member of President Obama's Council of Economic Advisors. Betsy, what are you going to be looking for?
Well, I'm going to be looking for how much agreement there is among the governors and other members of the FOMC board around whether they need to continue raising rates or not. You know, there was a pause in June. I think a lot of people are expecting them to raise rates again. But, you know, they have emphasized that they're going to be really data dependent. And I think it's going to be a really good time for us to try to take stock of where the different voting members are at to try to assess whether we should be expecting 0, 1, or 2 more rate increases this year.
I mean, the theory seems to be pause and then maybe 2 more, somewhere 50 basis points. Are we going to understand if sort of pushing out the hikes is truly because of uncertainty, or was it about pricing out the cuts for the market?
Well, you know, one of the things I'm also looking for is what are they doing with forward guidance? Because I thought the pause had a lot to do with them originally saying, like, we're not doing forward guidance anymore. I'm not going to tell you that there's going to be a rate increase next month. And then I think they should have maybe done a rate increase in June, and they paused because they hadn't told anybody to expect it. So I think they're having a really hard time walking away from the idea of forward guidance, and it'll be interesting to see what that conversation actually looked like. Because now what they've done is the markets are expecting another rate increase. That's standard forward guidance, and I think that they're going to deliver what people are expecting.
Betsy, last week we were trying to talk about central banks and their rate sort of setting policy through the medium of mountains. And it was, is this going to be the Matterhorn, i.e. we go straight up and then we come back down again, or is this going to be Table Mountain? You go up and you stay there. How do they communicate the stay there if they need to, and will these minutes be a useful vehicle to do that?
So I think we're going to need to stay there for a while. I don't think we go up and start coming right back down. You know, one of the great things so far is we have really seen a soft landing. I think we're going to see a strong jobs report on Friday. And that strong jobs report is going to let them know that the work they're doing is bringing inflation down, but it hasn't come at the cost of a recession, at least not so far. And so what they're going to want to say is that they're not going to be bringing rates down until they've actually hit their 2% target, unless there is significant need that the economy indicates it's really sliding into recession. I just don't think we have the evidence of that so far.
So let's go to the jobs. So you say you think it's going to be a good number. We also get ADP, challenger job cuts, initial jobless claims tomorrow. You get ISM services. Where would the cracks be if you were to look for them?
So I think that the cracks are going to be there if you look for them. What you're going to want to not do is just look at the headline number. In June, there's a lot of young people who are available to take jobs. We haven't quite seen as much of the seasonal fluctuations in the past couple years as we've had in the past. And so I think this year is going to look more like 2019 with just young people soaring in June. And I think that's going to help boost even the seasonally adjusted number. But what you're going to want to be looking for are things like, are we seeing people continuing to enter the labor force more generally? Are we seeing slowdowns in the sectors that have been fastest to recover? A lot of the job growth right now is being driven by the two sectors that were slowest to recover, leisure and hospitality, education and health services. I think we're going to see slowdowns across a lot of the other sectors. Is that what we're starting to see? I think you're also going to want to look for, again, what's going on